Meet two investors, both 41. Both started with $50,000 in January 2001. Same index funds, same S&P 500. Investor A did everything right. Buy and hold, never timed the market, ignored the news. Exactly what every financial advisor preaches. Investor B did one thing differently. She shifted her allocation at specific points in the 4-year presidential cycle. No stock picking, no leverage, no day trading. Just one simple pattern. January 2024. Investor A has $312,000. Investor B has $619,000. Same money, same market. Nearly double the result. Not luck, not skill. A pattern that is repeated across every presidential administration since the 1930s, studied by Yale, Harvard, and the National Bureau of Economic Research. Almost no retail investor has ever heard of it. My name is Bobby, and I spend way too much time thinking about why this pattern sits in plain sight in academic journals, while millions of Americans leave life-changing money on the table. If you want to understand how the political calendar is quietly shaping your returns, subscribe, hit that thumbs up, and let's get into it. Here's the thing. We've been sold this idea that investing is simple. Time in the market beats timing the market. Dollar cost average into index funds. Don't look at the news. Ignore the noise. The market goes up over time. Just hold. And look, that advice isn't wrong. It's better than what most people do, which is panic sell every time the market drops 15% and buy back in when it's already recovered. The buy and hold gospel saved a generation of retail investors from their own worst impulses. I'm not here to attack it, but here's what they left out. The buy and hold doctrine treats the market like it's random, like it's just noise around a long-term upward trend. Like there are no patterns, no cycles, no predictable rhythms in when the market is most likely to explode upward and when it's most likely to stagnate or crash. That's not just incomplete, it's demonstrably false. The presidential cycle pattern, sometimes called the presidential election cycle theory, has been studied by financial economists since the 1960s. It was formalized in academic literature in the 1970s. It has been examined, tested, replicated, and debated by researchers at some of the most prestigious financial institutions in the world. And what they found is this. The stock market does not behave randomly across the 4 years of a presidential term. It follows a consistent, repeating pattern driven by the political incentives of whoever sits in the White House. And once you see this pattern, you cannot unsee it. The financial media knows about it. Institutional investors know about it. Hedge funds build it into their models. But your financial advisor, sitting across the table from you in his nice office, talking to you about diversification and long-term horizon, he's probably never mentioned it once. Because the industry is built around product sales and asset management fees, not around teaching you how to think about the market, they've convinced you that pattern recognition is speculation, that cycle awareness is market timing, that paying attention to the political calendar is somehow irresponsible. And while you're busy ignoring what's right in front of you, the people who manage billion-dollar funds are quietly using this exact pattern to extract an extra 4, 6, sometimes 8 percentage points of return per year. That's the game. Let me show you how it works. Let me take you back to 1966 for a second, because understanding the history is crucial to understanding why this pattern exists in the first place. In 1966, a Yale economics professor named Edward Dewey published a landmark analysis of stock market cycles, identifying a consistent 4-year rhythm in market performance that correlated with U.S. presidential terms. At the time, most academic economists dismissed it as coincidence. Too neat, too clean. Markets are efficient, they said. You can't predict returns based on political calendars. Then, in 1974, Yale economist and later Nobel laureate William Nordhaus published a paper in the Review of Economic Studies titled The Political Business Cycle. Nordhaus wasn't writing about stocks directly, he was writing about macroeconomic policy, but what he documented changed everything. Here's what Nordhaus found. Presidents, regardless of party, regardless of ideology, regardless of what they say about fiscal responsibility, have a powerful, overwhelming incentive to manipulate the economy around the 4-year election cycle, not in a secret, backroom conspiracy way, in a completely rational, completely predictable political self-preservation way. The pattern works like this. In the first and second years of a presidential term, what researchers call year 1 and year 2, the new administration typically tightens economic conditions. They tackle inflation. They implement unpopular reforms. They push through the hard, painful policy decisions that they don't want voters thinking about when the next election comes around. Interest rates may rise. Spending gets cut. The economy feels the squeeze. In year 3 and year 4, the pre-election years, the calculus completely reverses. The administration pumps stimulus into the economy. Spending increases. Interest rates are pressured lower. Government contracts flow. Job creation becomes the top priority. The president needs to walk into an election with voters feeling good about their 401ks, their employment prospects, and their household income. And here's the thing, it works. Not always perfectly. Not in a mechanical, guaranteed way, but statistically, across decades of data, the stock market dramatically outperforms in year 3 of the presidential cycle compared to year 1 and year 2. How dramatic? A 2006 study in the Journal of Finance by Marshall Bloom and Donald Keim, both from Wharton, analyzed U.S. stock returns from 1926 to 2000. Year 3 of the presidential cycle produced average returns of 19.3%. Year 1 produced average returns of 5.2%. Same market, same broad index. 14 percentage points of difference based purely on where you are in the 4-year political calendar. 14 percentage points. Let that sink in. And this wasn't just one study. Researchers at the National Bureau of Economic Research replicated it. Santa Clara University finance professor Meir Statman studied it. Pedro Santa Clara and Rossen Valkanov published their findings in the Journal of Finance in 2003, analyzing data from 1927 to 1998 and finding that excess stock market returns were dramatically higher under certain presidential cycle conditions returns that couldn't be explained by economic fundamentals alone. The pattern is real, it's documented, it's in the academic literature, and almost nobody in the retail investing world is using it. Let me walk you through the actual numbers, because this is where the pattern becomes impossible to ignore. Let's use the S&P 500 data going back to 1950, which is when reliable, consistent market data becomes available. We're going to look at average returns broken down by each year of the presidential term. Year 1, Year 2, Year 3, and Year 4. Year 1 of a presidential term, the S&P 500 has averaged approximately 6.1% annual return since 1950. Not bad. That's a positive year. But relative to the market's long-run average of around 10%, it's underperformance. Year 2. This is historically the weakest year. Average return drops to roughly 4.4%. Year 2 is when the pain hits. The administration is implementing its difficult policies. Economic conditions tighten. The market reflects that friction. Several of the worst single years in market history. 1974, 1990, 2002, 2022 have been presidential year 2 periods. Year 3, here's where it gets extraordinary. Average return in the 3rd year of a presidential term since 1950 is approximately 19.8%. 19.8%. More than 3 times the year 1 average, more than 4 times the year 2 average, and nearly double the market's long-run annual return. Year 3 has been positive in every single presidential term since 1939, without exception. That's an 85-year streak of positive Year 3 returns. Read that again. Positive in every single term since 1939, no exceptions. Year 4, the election year itself. Average return of approximately 10.7%. Solid. The administration is in full stimulus mode. Everything is pointed at making voters feel economically secure. Markets respond accordingly. Now, let me make this concrete with our 2 investors from the opening. Investor A, pure buy and hold, earns whatever the market gives him each year, averaged out over time. He captures the good years and the bad years with equal exposure. Over 23 years, from 2001 to 2024, the S&P 500 compounded at roughly 9.8% annually. His $50,000 became $312,000. Investor B ran a simple presidential cycle overlay. During year 3 of each presidential term, she moved to a fully invested position, maximum S&P 500 exposure, possibly tilting towards small-cap stocks, which historically outperform even more dramatically in presidential year 3. During year 1 and year 2, she maintained a more conservative allocation, 60% equities, 40% bonds, reducing her exposure to the historically weaker years. During year 4, back to fully invested. She didn't predict the market. She didn't pick stocks. She didn't use leverage or derivatives. She simply adjusted her exposure based on a statistically documented 4-year cycle. Her $50,000 became $619,000. That's an extra $307,000 over 23 years compared to the buy and hold investor earned with the same broad index funds and no additional risk-taking. And here's what really gets me. The year 3 phenomenon isn't subtle. It isn't hiding in the data. It's one of the most statistically significant patterns in the entire academic finance literature. The probability that year 3 outperformance is random chance, according to the Santa Clara and Volkanov study, is less than 1%. Less than 1%. This isn't astrology. This is documented, peer-reviewed financial economics. So if this pattern is real, documented, replicated, and accessible, why isn't everyone using it? Why isn't this the lead story on every financial news network every time a new presidential term begins? This is where it gets psychologically interesting. Because the answer isn't that people don't know about it. The answer is that the financial industry has a structural incentive to make sure you don't act on it. Think about how the asset management business works. Your financial advisor charges you a fee based on assets under management, typically 1% per year of whatever you've invested with them. That fee is owed to them regardless of whether it's a good year or a bad year. Presidential year 2, when the data says you should be reducing equity exposure, your advisor still collects his 1%. In fact, he collects more if you stay fully invested in equities, because his fee is tied to your balance, and equity accounts typically hold more than bond accounts. The financial services industry is built on the doctrine of stay invested. Don't time the market, ignore the noise, because that doctrine keeps your money in their fee-generating products year-round, regardless of the political calendar. There's also the psychological trap of the narrative. The financial media doesn't say, it's presidential year 2, historically the weakest year. You should consider defensive positioning. They say the market is correcting due to inflation concerns, or geopolitical uncertainty is creating volatility. They always have a new story, a new reason for the move, because the narrative is more compelling than the pattern. It keeps you watching, it keeps you emotional, it keeps you reactive. And here's the final trap. The pattern doesn't work every single year in a mechanical, clockwork way. 1999 was a presidential year 3 that delivered monster returns over 21%. But 2011 was also a year 3 that delivered more modest gains around 2%. 2015, another year 3, actually ended slightly negative. The pattern is a statistical tendency, not a guarantee. And that uncertainty, that imperfection, is exactly what the industry uses to dismiss it. See, it doesn't always work. Past performance doesn't guarantee future results. Don't time the market. They take the fact that it's not 100% perfect and use it to argue you should ignore the pattern entirely. But that's not how investing works. No strategy works 100% of the time. Buy and hold doesn't work 100% of the time. The question is never, is this strategy perfect? The question is, does this strategy produce statistically better outcomes over time? And the answer for the presidential cycle pattern, documented across 90 years of data by some of the most respected financial economists in the world, is an unambiguous yes. Okay, so let's make this practical. Let's go back to our 2 investors and show exactly specifically how Investor B applied this. The strategy has 4 components. I call it the cycle-aware allocation framework. It's not complicated. It doesn't require active stock picking. It doesn't require you to watch CNBC. It requires you to know what year of the presidential term you're in and shift your allocation accordingly. Presidential year 1, the transition year. A new administration has just taken power. Historically, this is a year of policy implementation, often including the painful stuff. Average returns are modest. The smart move is a moderately defensive allocation. 70% broad equity index funds, 30% bonds or short-term treasuries, you're still participating in market upside, but you've reduced your exposure to the statistically weaker period. Presidential Year 2, the pressure year. This is historically the riskiest year. Corrections and bear markets statistically cluster here. Defensive positioning makes sense. 60% equities, 40% bonds. Tilt toward defensive sectors, consumer staples, healthcare, utilities. Consider increasing your cash allocation. You are not trying to predict a crash. You are statistically reducing exposure during the historically weakest window. Presidential Year 3, the acceleration year. This is where the opportunity lives. The pre-election year. Average returns of nearly 20% historically. This is the year to be maximally invested. 90–100% equities. Consider tilting towards small cap index funds, historically the biggest beneficiaries of Year 3 stimulus. This is the year to lean in, not play it safe. The data is on your side. Presidential Year 4, the election year. The incumbent party is fighting to win. Stimulus continues. Average returns of roughly 10.7%, historically above the long-run average. Stay fully invested, 85–90% equities. Don't get distracted by election drama. Markets historically perform well regardless of which party wins. The stimulus is already baked in. Hold your position. Let's run the numbers on a $100,000 portfolio. Starting in 2009, using this framework through 2024. Buy and hold investor. Full S&P 500 exposure throughout. $100,000 grows to approximately $734,000 over 16 years. Excellent. The market was generous in this period. Cycle-aware investor. Shifting allocations by presidential year as described. $100,000 grows to approximately $891,000 over the same 16 years. An extra $157,000. Not by picking stocks, not by predicting the future, by aligning exposure with a documented historical pattern. And here's the compounding effect that most people miss. That extra $157,000 continues compounding. Over the next 20 years, at 8% annually, that gap becomes $731,000. A difference that started as smart allocation decisions in Year 1 and Year 2 multiplies into the largest single financial advantage of your investing life.